Arash, another $4 billion deal in what has been a heck of a year for deals.
Absolutely, and there was another one just announced in the last 2 hours, which is a transaction between two sort of heavyweights of the consumer and pharma industry. GSK is selling its Indian subsidiary, or rather merging it into Hindustan Unilever, which is a subsidiary of Unilever, in a transaction that's going to add to Unilever's consumer portfolio in South Asia, and in particular bring it Horlicks brand, which is a malted milk beverage that is incredibly popular in India, and will add to its sort of emerging market footprint where Unilever is among the strongest. So two rather big deals. The Nexstar deal we're expecting to be announced within hours when the U.S. market begins.
You know, low interest rates are kind of the gasoline, Arash, on the deal-making fire. I mean, if you can't get returns one way, you're going to go someplace else to look for it. We're seeing interest rates come up just a bit. There's talk of slowdowns. Any indication that the deal market in the beginning of next year is going to slow down?
Interest rates have definitely played a major role in deal making. The availability of cheap leverage has made that incremental, more aggressive deal that larger companies have sought to do a bit easier. And as interest rates go up, that obviously complicates the math a bit and takes a little bit of the risk-taking dynamic out of it. But broader than rates, companies do deals for a bunch of reasons. And one of the things that's been driving them is the relatively open nature of markets over the last 4 years, which is why we've seen this incredible deal boom. But that's really now starting to cool off a bit with, as you've seen, the U.S.-China tensions, despite the latest news of the weekend. I think that thawing isn't going to be significant enough to sort of revive, the flow of Chinese deals into the U.S., which have now become a political concern and a security concern. And the U.S. deals into China were never that prolific. So we have two major drivers of cross-border deal-making really having cooled off, which will put pressure if there's any expectation that we're going to hit the same levels. The flip side is, even as rates go up, private equity is armed with a lot of cash. And at the moment, they seem to be doing ever more increasingly large deals. Last week, we broke a story at the Financial Times that Madison Dearborn has joined a group of private equity firms circling Nielsen, the U.S. market data and market research company, which could be one of the biggest buyouts since the financial crisis if it happens. And it looks like there will be a race for that asset starting in Q1 of next year between some of the biggest names in the industry. Elsewhere, Arconic, the sort of former Alcoa spinco, is another one that's being targeted by private equity. And what we're seeing is larger and larger private equity deals are becoming the main driver of M&A in the market, at least on the big ticket side.